Hello, good morning, everyone. Can you hear me clearly?
Yes, can.
All right,
Hello.
thank you. Okay, very good morning to everyone here. In my list, there's 47 people join the webinar now. Now it's 9 a.m. I think we shall start lah, huh? Let me share my screen now. Okay, can see my screen?
Can.
Okay, thank you, Emmy. Okay, once again, good morning, everyone. Thank you for joining this webinar at this 9 a.m. Probably we see we shall end by 3 or not, or we shall see lah as it goes. Okay, so today topics will be on this. Okay, sorry, let me slideshows here. Okay. Sorry. Okay. Our topics for why slideshow like this? Wait. Oh. Sorry. Let me see. Sorry. Sorry, I'm not sure. Some kind of technical problem. I'm not sure why my slide is moving. If my preview is like this, are you all okay? Should be okay lah, if there's no response. Okay, let us start today's sessions. There's impact of IFRS for SME third editions on MPERS. As you know, there will be a new MPERS, that is MPERS 2025, that will be effective from 1st of January 2027. So we are preparing for that. So we need to know what are some of the major amendments and some of the minor amendments that you may need to know, because some of it may affect your presentations of the AFS for MPERS, right? So now we talk about some of the history first lah, ha. Okay, IFRS, this is international standards lah. IFRS for SME accounting standards issues an immediate effectively that is the first editions in 2009. Right, this is IFRS lah, not in MPERS content. So the second editions issued in 2015, which is some of the amendments from the first review issues that is effective from 2017. I think everyone of us here, I'm not sure whether the new assistant, you know, when the first time we adopt MPERS is on the 2016, if I can recall that. Okay, so now there is now it's effective in 2027, which is the third editions of the IFRS for SME. Okay, so it will be effective 2027, 1st January. So it's about 10 years apart. Okay. This is in the context of the international standards. What's about the MPERS? So same MPERS first issued by Malaysian Accounting Standard Boards as a framework for private entities in 2014. Okay, when IFRS amend the second editions in 2015, so MPERS also issued some limited amendments to maintain the alignment with the updated standards with IFRS for SME. So 2025, MSB also issued the exposure draft 80 MPERS, proposing a revise of the MPERS that we now call MPERS 2025 to be fully aligned with the third editions of the standards. As I mentioned just now, this MPERS will be 2025. Maybe I would say the new MPERS will be effective for the annual reporting periods beginning on or after 1st January 2027. Earlier applications is permitted. So if your client asks whether you can adopt it earlier, you may adopt it earlier. Maybe 1st January 2026. All right, so you have to be prepared for that because some of the amendments will affect the presentations of the financial statement for MPERS. All right, so before that, do you know what is MPERS and what is MFRS? Okay, MPERS is only applicable for private entities. Maybe we have to study a bit or refresh a bit. Okay, under this sections 1, okay, MPERS are purely applicable to only private entities. So what is the definitions in the MPERS sections 1 for private entities? Okay, private entity, let us see. Private entity, as defined in sections 2 of the Companies Act 2016, is not itself required, okay, is not itself required to prepare or lodge any financial statement under the law administered by SC or BNM. Okay, what is SC? Sorry. SC is Security Commissions. That is listed, those listed companies in Bank Bursa, the Bursa Malaysia, you cannot adopt this MPERS or BNM, Bank Negara Malaysia. Those regulators from BNM, okay, those companies have to report their financial report status to BNM. Is not allowed to use MPERS. Okay, remember this. Okay, B or itself is not a subsidiary, associate of, or jointly controlled by an entity which is required to prepare or lodge any financial statement under SC and BNM. So not only itself, the parent itself, but inclusive of their subsidiaries or associates or jointly controlled entities, they also cannot adopt this MPERS. All right. So this is the definitions of private entities. Some of you might know already, so just as a refresher, some of you might be new. So this is, you have to understand which entities can apply or adopt MPERS, which entities cannot adopt MPERS. All right? Okay. I will not go through all the sections in the new MPERS 2025. Okay, eventually for these sections, I will just go through the major amendments of the standards and some of the minor amendments of the standards. Okay, if there's some other minor amendments to the standard that I didn't go through, you might have to go to the MSP board, the website. You can download their amper standards and read what are the changes. Okay, eventually there's this. I'm not sure whether you can see or not. Let me make it bigger. Okay, you can see. Okay, this later on I will share these slides to this. I think I will ask Amy to share these slides to all of you. Okay, after this session start. Okay, so this third edition at a glance, you will see there's minor, major, minor, or some of the standard are just editorial changes, like a change of some wording. Okay, major means substantive changes to the requirements are proposed. Okay, so I will go through the major amendments and some of the minor changes to requirements are proposed, some of the minor amendments and editorial. Okay, you can refer to this whole sections. What are the whether there's minor or major changes? All right. Okay. What are the major amendments to IFRS for this new MPERS? Eventually, there's this 1, 2, 3, 4, 5, 6. 6 major amendments to the standard in these 6 sections. The first one is sections number 2, the concepts and the pervasive principles. Sections number 9, the consolidated and separate financial statements. Sections 11, initially in the current MPERS, there's this basic financial instrument, and there's section 12, that is other financial instrument. But eventually in this new MPERS, they have combined that 2 sections, sections 11 and section 12, the basic and the other financial instrument, into 1 sections, that is sections 11, and name it as financial instrument. There's no differential in sections 12 or sections 11. So they combine it to 1 sections. Okay, and there's a new sections, that is section 12 on the fair value measurement. There's purely 1 sections for this fair value measurement. Initially, they don't have any sections on this fair value. Okay, it's like MFRS, there's 1 sections specifically for this fair value measurement. So the new standard has been aligned with the MFRS already. There's a new sections. Okay. And next is the sections 19, business combinations and goodwill. There's some changes to the principles for these business combinations and the definitions of business that I will go on later. And also this sections 23, revenue. Okay, eventually they has renamed the revenue to revenue from contracts with customers. Sounds familiar, right? For those that who have been involved in MFRS, I think you will be familiar with this 5-step model, revenue from contracts with customers. You have to identify revenue with this 5 steps model. even in MPERS as well. Okay? Not only MFRS, but there's some simplifications lah, not as stricter rules as MFRS. All right, so for today's sessions, we'll be going through these major principles to see what are the changes to these 6 sections. All right. So far, no questions. If there's any questions, you may post into the chat box or to the Q&A box. If I can answer, I will answer because this is also new to me. Okay. Okay, so now we will go through one by one for the major amendments, detailed sections amendments here. Okay, we will go to sections 2, the concepts and pervasive principles. Just now, sections 1, we have go through what is the definitions of private entities, who can apply MPERS. So you know who can apply MPERS are the private entities that not listed, that not required to report their financial statement to the SC or Bank Negara Malaysia. Okay, understand? So this is sections number 2. What are the concepts and pervasive principles, okay, to prepare the financial statements? Okay, so what is sections number 2? Okay, let me read. This section described, okay, what is the objective of the financial statements of the private entities. It's also set out the concepts and basic principles underlying the financial statement of the private entities. Okay, previously it was this section 2 is based on the 1989 law. I believe some of you might not be even born yet. Framework for the preparations and presentations of the financial statement, and now it's aligned to the newer one, the conceptual framework for financial reporting 2018. So they are now aligning it to this conceptual framework. The 3 dots here, these are the changes, that the amendments to these sections 2 in relation to the concept and basic principles. The first one is the concepts of the prudence, stewardship, measurement, uncertainty, and substance over form are clarified in the standards. Number 2, the definitions and recognition criteria for assets and liabilities are updated. So eventually they update the definitions of the assets and liabilities in this new sections 2. Number 3, there's these new concepts on measurement, presentations, and disclosures and guidance on the derecognitions. Okay, when you how you measure the derecognition. So it's all stated in the sections 2 as at now. All right. Okay, let us read this first. The sections 2 is part of the standards and therefore has equal authority to other sections of the standards. Okay, but this IISB eventually added a new paragraph, okay, relating to this overriding principle, that the requirements in other sections of the standard take precedence over sections 2 in order to resolve any potential inconsistency between sections 2 and other sections of the standard. Later on, I will have one scenario to explain what is this taking precedence meaning. You will get more depth in detail of this taking precedence. In short, which means if there is inconsistency between the standard, so the other standard will take precedence over sections 2. All right, you hold on first. Later, I will describe what is this means. All right. Okay. Fortunately, I believe everyone like this undue cost or effort. Fortunately, the IISB retained the concept of undue cost or effort. Okay. The concept provides the IFSB with a tool that helps to balance the costs and benefits of the specific requirements. The concept also gives SME a way to make the best use of their resources and get some relief from specific requirements. SME that use the exemptions are required to provide disclosure about how and why it has been applied. Not each of the sections you can just use undue cost or effort lah. You have to refer which sections that you can use this undue cost of effort, and you have to explain your basis why, okay, why and how you use this undue cost or efforts. Not just simply, oh, I cannot apply these sections that I use undue cost or effort, all right? No, you have to refer to each of the standard, which standard can use this undue cost or effort. Right, so this is just a brief to these sections to what are the amendments. I will go through on later. Okay. So I'm in next slide. I'm in slide 12. I hope everyone can see. Okay, so these are the amendments. As I mentioned just now, there's these definitions of assets and liabilities. There's clarifications, right? Currently, there's none. No definitions of assets and liabilities in the standards. But in the revised copy of the MFRS, okay, they have specifically mentioned what is the definitions of assets and the liabilities. An asset is a present economic resources controlled by an entity as a result of past events. Okay, and what is liabilities? A liability is an entity present obligations to transfer an economic resource as a result of the past event. Okay, so there's these definitions already clearly stated in sections 2 of which there's none in current MFRS. Okay, how about the measurement basis? Currently, the measurement basis is based on the historical cost and fair value. Okay, but they have revised it to this. Now the measurement basis, okay, you can measure at historical cost or current value. This current value, it can include fair value, current cost, the value in use for assets, fulfillment values for liabilities. Okay, so you can refer to the standard lah. What is fair value, what is current cost, the value in use for assets. So you can refer to that standard. The derecognitions, okay, before that, there's none. Under the current MFRS standards, there's none on the derecognitions. But now, okay, there is this definitions like derecognition is the removal of all or part of recognized asset from entity in the statement. Okay, you can refer clearly in the sections number 2 lah, in the new MFRS. I believe every one of you know how to get the MFRS standards through your MSB, right? Do I need to show you where you can get? Maybe later on I can show you where you can get the MFRS, where you can refer to that. All right. So these are the 3 things just now I mentioned right here. Through aligning with the conceptual framework, there's these 3 changes: the definitions, the derecognitions, and the measurement uncertainty are clarified. So this is the one that I mentioned. That's this new amendment. Okay. So now we are going to slides number 13. So in this sections 2, okay, there is this they have segregated to this fundamental qualitative characteristic. Means what are the qualitative characteristics of information that you should present in your financial statement, right? It must be relevance and show a faithful presentations. Relevance means you can influence, okay, your users' decisions. Faithful means you're free from error, completeness, and no bias in selections in the presentations of the financial statement. Okay, financial information only useful if it is relevant, right? And faithfully represent what it's purposely to represent. Okay, that you can affect your users' decisions whether I can invest in this company or not to invest in this company. So you must the financial statement must be relevant and faithful, right? Free from error, complete, and there's no bias in the selections of the standards. Okay, then it also further enhancing the characteristic if your financial statement is comparable. Okay, you can compare. Okay, and verifiable, timeliness, and understandable within this cost constraint. Because eventually when you need to prepare a financial statement, you need manpower, you need time, okay, you need cost to prepare this financial statement. You need to collect your data. All these are cost constraints to prepare the financial statements. So you have to weigh the benefits of the cost and the benefits in preparing these financial statements. So these are the characteristics that included in the new sections that you have to prepare financial statement that is relevant and have faithful representations. Okay. And this is what I mentioned just now. Your relevance. Information is relevant if it can influence the user's decisions, right? And faithful presentations. Information must be faithfully represent the substance of what it purports to represent. And also you need to consider the enhancing qualitative characteristic that I mentioned just now. Comparability, verifiable, timeliness, and also understandable. The readers must understand the things that included in the financial statement to be useful, right? So that will be enhance the characteristic of the financial statements. All right. Okay. So just now I mentioned about the taking precedence. Okay. In sections 2, there's this new para mentioning that other sections will take precedence over sections number 2. Okay, let's see this scenario, all right? An entity is considering developing an accounting policy under which each purchased brand asset has an indefinite useful life, and therefore indefinite useful life, which means they have no finite life. Okay, not 10 years or 20 years or 30 years, but indefinite years. Okay, so, and therefore the intangible assets would not be amortized. Is this correct? So management assumes this policy would satisfy the principle of faithful representations because it anticipates that the brand will hold its value, which means that management assumes that, okay, that's this brand asset will have indefinitely useful life. Okay, and it's in accordance to sections number 2, right? Just now what I mentioned. Okay, I prepare a financial statement that is relevant and faithfully, so and adopt this. I believe it anticipates. I believe that in line with the principle of faithful representation. So I will not amortize that intangible asset. Okay, but all right, but in sections 18, intangible assets other than goodwill requires that all intangible assets be considered to have a finite useful life. Okay, sections 18 is not allowed a company to have this intangible asset that have indefinite useful life. You must have a finite life, which means you have a finite useful life, maybe 10 years, 20 years, or whatever years lah, huh? So, management proposed approach is therefore is not permissible. This is what I mean, taking precedence, which means if it's contradict with sections, other sections, in this case, sections 18, so you cannot not to depreciate not to amortize the intangible assets, but you have to amortize the brand assets based on finite useful life that is in accordance to sections 18. Okay, section 18 will taking precedence over sections 2. You cannot say, oh, never mind, because sections 2, I can use faithful representations. Okay, so if there's inconsistency, you have to apply other section instead of sections number 2. All right. Until now, I believe there's no questions, right? I don't see any question in chat box. Okay. We have completed sections 2 on those the amendments. Okay, let me show you you can see okay, this is the I'm showing you the amper standards, okay, that I downloaded from the MSP board. This is what I mentioned, the sections 2. Okay, this is the new sections 2.2 take precedence over the concepts, which initially there's none of this 2.2 in the current standard. Okay, you can check. Okay, so this is the objective. Okay, this is the qualitative characteristic where there's this fundamental qualitative characteristic. Okay, you can refer what is the definitions for relevance, okay, the faithful presentations, and also the enhanced qualitative characteristic, comparability, verifiability, timeliness, understanding, all are mentioned here. Okay. This is the new standards. All right. Okay, so far, okay, sections number 2. Okay. So now, we will go to the next section. That is sections number 9. The consolidated and separate financial statements. I'm not sure whether all of you have consolidations accounts, consolidations or not, but there's amendment to this, so you have to understand and see what are the amendments to these sections number 9. Okay, basically, these 3 are the changes. Okay, on the control model basis. Now, sections 9 use the control as a single basis for consolidations under MFRS 10 rules. Okay, and loss of control effects and the rebuttable presumptions. Okay, that's these 3 major changes. Okay, I'm in slide number 18. Okay. There's this first amendment on the definitions of the control. Okay, has been updated to mirror that in the IFRS or MFRS 10, which use the definitions as the single basis for consolidations, means the control model. Okay, we go through what is the current definitions of control of an entities in the current MPERS. The power to govern the financial and operating policies of an entity so as to obtain benefits from its activities. Okay, it's very short. To govern the power to govern the financial and operating entities to obtain the benefits of from its activities. Now the revise of the control definitions, a bit longer. Okay, let us read together. An investor controls an investee, when the investor is exposed or has rights to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. Okay, when the investor can control over the investor, the investee, you must clearly have these three elements inside. Okay, you have to consider whether you have the power over the investee. Okay, you have the power. You have the exposure or rights, okay, to variable returns from the involvement, whether you have variable returns, and the ability to use your power to affect the amount of investor returns. Seems long, huh? Okay. So what is power? Okay, power has the right to give the ability to direct the relevant activities. Mean you have certain boards of directors. Okay, you can approve certain of the budgets or direct that, oh, you have to invest to these activities or investment to get your returns. Okay, to get returns. Okay, so and the link between the power and the returns. Investor has the ability to use the power to affect its returns from the involvement with the investees. Okay, so you have to get these three elements in order to show that you have control over these entities. Okay, let us see a scenario that I've okay. So this subsidiary with special rights. Okay, you see, your company A, let's say, your company A owns 48% of subsidiary X. All right, 48% only. Does it consider subsidiary? No, right? You basically you have to over 50. So you only have the control over subsidiary X. So now this company A owns only 48% of subsidiary X. Okay, but you see, company A has this contractual rights to appoint key management and approve the budgets. Okay, so this company A has the rights to appoint the key management or the directors to approve the budgets. Okay, company B. So company A owns 48%, though this company B owns 52%, which is more a percentage of holding the shares as compared to A, right? But company B rights are protective. Okay, cannot direct any activities in the subsidiary X. Okay, and company A earns dividends and the management fee based on the performance. Okay, so when there's this new amendment to the sections on the power return on the to direct the activities. Okay, so you see, power. Company A directs relevant activities through management appointment and budget control. Just now I mentioned company A has the power, right, to appoint key management and budget control. Okay, so how about the exposure variable return? So company A can benefit from the dividends and the fees. Ability to use the power to affect the returns. So by controlling the operations, company A can influence the profitability of subsidiary X, right? So in conclusion, even though company B owns 52%, it does not have any contractual rights to direct the activities in subsidiary X. Instead, company A, even though only 48%, but it has the contractual rights to control subsidiary X. So conclusion, who is the parent of subsidiary X? Company A. So company A has to consolidate subsidiary X. I think it's more or less same like MFRS already, right? You have the power, you have the exposure to variable returns, then only you meet the definitions of control. It's not merely looking at the percentage of the control ownerships only, but you have to see, okay, who is the controlling party, who can direct the financial and operations activities of that subsidiaries. Eventually, that will be the parent of the subsidiary X. All right. So not only looking at, 60%, then I consolidate, it's my subsidiary. So, okay, so you have to reconsider again due to these amendments on the control definitions in these sections number 9. Right? Okay. I hope all of you still awake. Now it's only 9:41. Okay. Another amendment on the sections number 9 is the rebuttable presumptions. Okay, currently the rebuttable presumptions in sections 9 that control exists when an investor owns the majority of the voting rights of investee. Now revised to rebuttable presumptions simplify applications of control models. What is this? What is this rebuttable presumptions? As I mentioned just now, okay, the presumptions of the users is that when I hold 60% of the subsidiary X, okay, the presumption is I will have control, right? Control is presumed like this here. Control is presumed, the control is presumed to exist, okay, when the investor owns a majority of the voting rights of the investee. Like just now, when I say, the company B has 52% of subsidiary X, I presume the control exists, right? But you can rebut the presumptions, okay? Which means the rebuttable presumptions, okay? Like what I mentioned just now, even though company A has only 48%, okay, I can rebut the 52%, I can rebut the presumptions that I have no control over the subsidiary X. Maybe a bit of confusing here and there. So this you see, this is the source is from IFRS Foundations on the how you apply these rebuttable presumptions. Okay, so you see, where does the investor own directly or indirectly through subsidiaries a majority of the voting rights of an investee? Okay, so we go to yes first. So, okay, investor own directly or indirectly through subsidiary a majority of voting rights of an investee. Okay, you say yes. I've got 60%, so I have the majority of voting rights. Sorry, let me see. Sorry, this is the voting right. Majority of the voting rights of the investors. Yes. So does the investor choose to rebut the presumptions? So if yes, then the investor does not control the investee. If no, the investor controls the investee. Okay, so so another line is, does the investor own directly or indirectly through subsidiaries a majority of the voting rights of the investee? If no, then the Investor have all the elements of the control in paragraph of the 9.4b. If no, then does not have control. If yes, then you control the investees. Let's show another examples. Okay, this is more easier to understand, I think. Okay, for instance, like this, SME A holds 60% of SME B. SME B holds 70% of SME C, right? Okay, so if the simplification, which means you hold more than 50%, you see SME control B and C, right? SME B control C. Okay, let's see another situation. In simplifications, if more than 50%, then there's a control over B and C. Okay, but you can rebut the presumptions. Okay, if in this case, SME A have 60% of SME B, okay, and SME C has 40% of SME B. All right, so simplifications, who is holding SME B? Who has the control over SME B? You see it's SME A, right? Because eventually SME A has more shares in SME B, which is 60%. Also SME A console SME B, correct? Okay, but you can rebut the presumption. Okay, if you see SME C, even though I hold less than I hold only 40% SME B, SME C has the contractual arrangement with SME A that give SME C the exclusive right to appoint and remove the board of directors of SME B. Okay, so the board of directors make decisions about relevant activities of SME B. So who ultimately have the control over SME B? It's SME C, right? Even though I have only 40%. So SME A can rebut the presumptions. Means I rebut the presumptions that I don't have control is in SME B. Yes, even though simplifications, I hold 60%, it's more than the 50%. Eventually, I should be the parent, but I don't have any contractual rights or any decisions making in SME B. So I rebut the presumptions that I'm not controlling SME B. Indeed, SME C control SME B. Understand? The rebut presumptions. I'm trying my best to explain what is rebuttable presumptions. So meaning to say you can rebut the presumptions because generally when you hold more than 50%, then you say, oh, I have control over the SME B, okay, the company. But eventually I can rebut the presumptions that I'm not controlling SME B when I don't have any contractual rights or any decisions makings in affecting the activities and operationals or financial of SME B. Right? Basically, you have to redefine your control elements over the subsidiaries, whether you have control based on the elements that I explained just now. All right, this is the new new principles in MPERS. I think it's more eventually aligning to the current MFRS to redefine the control. Okay, so now I will go to next amendment in sections number 9. Okay. This is the new paragraph in the sections number 9, where you can refer to 9.18a. This is when a parent loses control of the subsidiaries. So in this case, parent must measure any retained interest in the former subsidiary at fair value on the date control is lost. Okay, you have to measure the fair value at the day you lost the control over a subsidiary and recognize any gain or loss to the profit or loss. Okay, I'm not going to read all this. You can refer to 9.18a. Okay, but I have, okay. This is what I mentioned just now, the recognitions and measurement requirements. If you loses control over the subsidiaries, you have to de-recognize your carrying amount of your assets, your liabilities, and if there's any non-controlling interest. And you have to recognize the fair value of the consideration received and the fair value of interest retained in former subsidiary. Okay, the difference you recognize in the profit or loss, whether it's gain or loss. Okay, I have copied an examples. Okay, when you have losing control over a subsidiaries. Okay, let's read together. This also I copied from IFRS Foundations. Okay, let's say you have this SME A has a wholly owned subsidiary, which means 100% of SME B. Okay, there's no NCI for simplifications, no NCI. So SME A wholly owned subsidiary, SME B 100%. Okay, on March 20 X1, SME A sold 90% of the shares in SME B to a third party for a price of 1,350. So this is the fair value that you get from disposing the subsidiary, 90% of the subsidiaries. Okay, so the carrying amount of the net assets of SME B is currently the carrying amount is 1,280. Okay, so the fair value of the remaining interest of the 10% is 128. Okay, so just now, in relation to this, right, you have to de-recognize the carrying amount first. Then you recognize the fair value. Okay, so you de-recognize your carrying amount first. Okay, your carrying amount. Okay, then you recognize the fair value, 1,350 plus 128. Okay, how much? 1,350 plus 128 is 1,478. And you minus 1,280. You have to recognize the gain or loss of 198. Okay, the fair value of the considerations and the fair value of the interest retained in former. So this is the examples given in the IFRS Foundations. All right. Okay, and there's this the other amendment in the sections number 9, right? There's this currently in relation to exempted parent, currently there's this A and B, and there's this new paragraph. And also the disclosure in separate financial statement. This is the current, and there's additions of para here. Okay, maybe you can refer to the standards. Exempted parent, a parent that is exempt in accordance with paragraph 9.3, this is the 9.3, from preparing consolidated is permitted to present separate financial statement as its only financial statements. Disclosures in separate financial statement. Okay, additions. You have to add in your new disclosures. Okay, on the consolidated financial statement or financial statement to which they relate, or the name and the principal place of business of the entity whose consolidated financial statement comply with full MFRS accounting standard or with this standard, if the entity has chosen not to prepare the consolidated in accordance with paragraph 9.3, which means you have to disclose that if you don't prepare the consolidations, the consolidated accounts, so what you need to disclose, what additional notes you need to disclose. Okay. Okay. So basically, these are the amendments to sections number 9. Okay. Now we are going to sections 11. Okay. As I mentioned during this morning, right? Previously, there's these two sections, sections 11 and section 12. Section 11 is the basic financial instrument. Whereas for other financial instrument is governed under sections number 12. But currently, section 11, okay, sorry, it should be section 11 financial instrument, not basic financial instruments. Sections 11 has been renamed to financial instrument that consists of part 1 and part 2. Part 1 is the basic financial instruments and part 2 is the other financial instruments. So they have eventually combined that two sections into one section, that is sections 11, financial instruments. All right? So basically, there are these 4 new amendments to the financial instrument. The first one is the added principle that supplement the classifications and measurement requirements for financial instrument. Secondly, there's new disclosure requirements for financial assets and financial liabilities. Third, there's added definitions of financial guarantee contract and the amended on the requirements for issued intra-group financial guarantee contracts. Fourth, they have removed the options to apply the recognitions and measurement requirements in IAS 39 financial instrument recognitions and measurement. Okay, they have removed the options whether you can apply the IAS 39 or section 12 or section 11. So they have removed that. Okay, fortunately, the IASB retained, what a good news to us, the incurred loss model, not expected loss model, which is more complicated when you measure the impairment. So fortunately, IASB still retained the incurred loss model for the impairment of financial assets measured at amortized cost. The H accounting requirements and the derecognition requirements, they still retain these. All right. Okay, I will go through one by one on the amendments that I mentioned just now, these four amendments, one by one. Okay, so there's this, the first one, as I mentioned just now, there's these additions of the supplementary principle for classifying the debt instrument based on their contractual cash flow characteristics. Blah, blah, blah. I don't want to read this, but I have a flow chart explaining on this 11.9 ZA. Okay, this supplement principles is mentioning that, okay, when you can recognize that instrument under sections 11, part 1 or part 2. So you have to consider this table. Okay, is the debt instrument within the scope of sections 11? If no, then you apply other sections. Okay, if yes, does the debt instrument satisfy the conditions in paragraph 11.9? Okay, you go to see what is 11.9, whether you can satisfy those conditions as mentioned. Okay, if yes, then you can apply sections 11. If no, then you have to see whether the contractual cash flow solely on principal and interest. If yes, if solely on principal and interest, if yes, then you apply part 1 of the sections 11, that is on at amortized cost. If no, you cannot apply sections 11, part 1, then you apply part 2, which means you have to measure the debt instrument using fair value through P&L. Okay, there's a list of conditions that you need to make in order for you to recognize the using part 1 of sections 11. If not, then you have to measure at fair value through P&L. Okay, so this is the supplementary principle added in the sections 11. Okay, another amendment to this sections 11 is on the additions of requirement to disclose an analysis of the age of the financial assets and also the maturity analysis of the financial liabilities. Sounds familiar for those who do MFRS. You will show this in your financial statements, right? But there's no requirement to disclose these informations in MPERS account. But commencing from 1st January 2027, you have to disclose this analysis in your financial statements. Okay, financial assets, you have to show your age of trade receivables and other financial assets. Financial liabilities, you have to show the maturity analysis for the financial liabilities. This is the examples, okay, to be presented in your financial statement. The analysis of the age of the trade receivables. Okay, you have to show your aging less than 1 month, 1 to 3 months to 1 year, more than 5 years. Okay, you have to show before impairment first, the gross figure, then show what is your impairment and your net figure. Okay, so you have to add this disclosure in your financial statements. Okay, for financial liabilities, you also have to show your maturity analysis. Okay, what is less than 1 month, 1 to 3 months, 3 months, and 1 to 5 years. Okay, your bank overdraft, your trade payables, your bank loan, interest payable, you have to show the maturity analysis in your financial statements. All right. Okay, just now that is the first amendment and the second amendment. Now we come to the third amendment. Okay, on the added definitions of financial guarantee contract. What is financial guarantee contract? And the amendment on the requirements for issue intra-group financial guarantee contracts. I think most of us encountered this financial guarantee contract in our engagement. Okay, so I'm going to read what is this first. Then I have a scenario on how to calculate the financial guarantee contracts. Okay, so what is financial guarantee contract? Okay, financial guarantee contract is a contract that requires the issuer to make specified payments to reimburse the holder for a loss it incurs because a specified debtor fails to make payment when due in accordance with the original or modified terms of that instrument. Which means you give a financial guarantee to your maybe your other company, okay, or your intra-group or the other companies that common core directors companies or your subsidiaries, okay, the financial guarantee contract. If they fails to pay, then you as the issuer of the financial guarantee contract, you have to pay. So this is the financial guarantee contract. Okay, so there's this new amendment. Intra-group financial guarantee contracts issued for new considerations. Okay, which means if a parent issue financial guarantee to a subsidiary at a new considerations. Okay, so these are accounted under section 21, okay, not sections 11. Okay, sections 21, which means a provision is only recognized when the entity has a present obligations as a result of a past event. It is probable that an outflow of the economic benefits will be required to settle the obligations, and the amount can be estimated reliably. Which means if you are the parent, you provide a financial guarantee to a subsidiary at the new considerations. Okay, if the subsidiary is able to pay, then perhaps you just provide a disclosure in your financial statements, because there's no outflow. The outflow is not probable because your subsidiary still can pay the no default, still can pay the amount. So under sections 27, you only recognize when it's probable that you'll be required to settle the obligations and the amount can be measured reliably. Okay, as usual, but that is only for intra-group financial guarantee contracts within the group, a parent and a subsidiary within a group. Okay, all other financial guarantee contracts, which means if you give a financial guarantee contract to your common core director or whatever, it's not within a group or outsider, all right? So these are included in the scope of part 2 of the revised sections 11, and you have to measure at fair value changes recognized in the profit or loss. Okay, now these sections is specifically mentioned in the standards already. So you have to measure that financial guarantee contracts. Okay, please take notes on this. Okay, I believe everyone have these issues. So I give you an example, a scenario, when you give a financial guarantee contract to your company director's company, how to measure, how to recognize or measure the financial guarantee in your financial statements. Okay, let's say this. Your company guarantees a loan of 10 million taken by a common director company from a bank. Okay, so your company guarantees the other company to borrow a loan from a bank. Okay, so the loan term is 3 years. Let's say if interest rate without that guarantee is 10%, okay, when you go to the bank, the interest rate will be higher, right? Because there's no pledge of anything, or there's no backup by some company. So eventually your interest rate will be much more higher than with a guarantee. Okay, so interest rate with guarantee is 7%. In scenario, no premium charge for the guarantee. So the risk-free discount rate is 5%. So how are you going to fair value the financial guarantee contract? Okay, so the first step, you have to determine the benefits of the guarantee. Okay, which means if includes the guarantee, you'll be charging at 7%. If without the guarantee, you'll be charging at 10%. So you benefits from the interest is 3%, right? Okay, this 3%. 10 minus 7 is 3%. So what is your annual interest saving for the borrower? 10 million times 3%. So your interest saving is 300,000 per year, let's say. Okay, 3% per year. Okay, then you calculate the present value of the interest savings. Okay, you discount the 300,000 for 3 years at 5%. Then you use your calculator or Excel or whatever. You calculate the present value. Eventually, it will give you a figure of 816,900. Right? So at your initial recognition, you have to recognize the financial guarantee liability for 816,000 and the corresponding expenses. Okay, then subsequently measured at amortized cost to reverse this 816,000 within 3 years. Okay. Understand? Okay, that is the third amendment that I think you should reconsider, Saha. Okay, the fourth amendment of sections 11 is the removal of the options for an entity to apply the recognition and measurements requirements of IAS 39. Okay, this accounting policy choice has been removed. This 11.2 has been deleted. Okay. Okay, so we have completed sections 11. On the financial instrument. That's the 4 amendments that I need to tell you about that. Okay. So now we'll be going to section number 12. Is there any questions so far? Let me see the chat box now. Q&A. No. If there is no questions, I think we can end very fast. Because now I'm in the slides of 41 already. I have about a total of 90 slides. So far, all of you still can catch up, right? Okay. Maybe we go for another sections, that is section 12. Then we have a break. Okay, we have a break. Then you see if there's any questions, you may post to the chat and Q&A sections. Then we continue the remaining of the slides. If we can finish earlier, then maybe half day we can finish these sections. Okay, so come to this new sections 12, that is fair value measurement. Okay, before that, currently the AMPers, we do not have this sections number 12, that is the fair value measurement. But from now on, you have to know about this fair value measurement. What is the definitions of fair value? Okay, I think every one of us always heard about this fair value thing. Okay, and fair value is the price that will be received to sell an asset or paid to transfer a liability in an orderly transactions between market participants at the measurement date. Okay, later on we'll be going through one by one now. Okay, what is the characteristic when you measure the fair value? Okay, you have to consider the conditions and the locations of the assets, if any, on the sale or the use of the asset, whether there's any restrictions to use. And the assumptions made is the principal market for the assets or liability, or in the absence of the principal market, the most advantageous market for the assets or liabilities. Okay, these assumptions you have to make when you determine your fair value measurement. You have to use the highest and best used, okay, principle to measure your assets. Okay, you have to consider the physical characteristic, okay, of the assets, the size, the locations, and the conditions, okay, and whether there's any legal restrictions, whether there's any zoning, or you need a permit to use on that lands. And lastly, that's generate adequate income or cash flows. Okay, I give you an examples how you measure this fair value measurement using this highest and best use. Okay, for example, the first examples are on the land. Let's say a company owns a piece of land currently used as a warehouse. Okay, they own the land and use as a warehouse. Okay, zoning laws allow commercial development. Okay, market participants would pay more for the land if it were developed into a shopping mall. So what is the highest and best use of this land? Eventually, it will be commercial development and not warehouse. Okay, because it's the physical characteristic, okay, is located at a strategic place, okay, where there's no legal restrictions that you cannot build a residential shop lots. So eventually the land will give its highest and best use value is the commercial development and not the warehouse. Okay, how about the plantations? For example, like a palm oil plantations near a growing residential area. Market participants may value it more for housing development than for continued agriculture use. So the highest and best use is the residential development. Okay, which means that when you need to measure, the fair value measurement, you need to determine the highest and best use of that assets. Okay, not just our warehouse, then probably it's just 10 million. Okay, but the piece of land, eventually the fair value is much more higher if there's no restrictions or whatsoever zoning law, and it's appropriate for a development. So eventually the market value for the land is 50 million and not 10 million. All right, this is how you you determine the fair value of the assets. Okay. Okay, as mentioned in the AMPER standards, so there's this 3 valuations techniques. Okay, you can use these techniques to value your assets. The first thing is the market approach. Market approach is uses the inputs, the price, and other relevant information generated by market transactions. Okay, the market approach. Let's say I got examples. I got examples later on. Oh no. Okay, which means you can get this price by comparison, or you can use the market approach. You can compare to the market available prices. Okay, like you use bricks or JPPH, the market approach. Okay, secondly, you can use the cost approach. Okay, cost approach is calculates the amount that will be required currently to replace the service capacity of an asset. Means like a replacement cost, replacement cost to build a new building. What cost you need to add on? So that is the cost approach. Income approach. Income approach is like converts the future amounts. Okay, for example, this cash flow or income and expenses to a single current that is discounted amount. That is what we call the DCF, the discounted cash flow. Okay, you need to calculate what's the income, what's the expenses for a certain period of time. What is your DCF to calculate the value? So basically, this is the valuations technique that you can use to calculate your fair value. Okay, market approach, cost approach, and income approach. Okay, there's this level 1, 2, 3. Okay, I believe every one of you know what is level 1, 2, 3. So level 1 is the unadjusted quoted price, which you can see active markets for identical as for liabilities the entity can access at the measurement date. Like your investment in those quoted shares, right? You can directly, the shares price is 3 ringgit, then directly you can use that as your value. So that is level 1. Level 2, inputs are directly or indirectly observable inputs other than quoted price included within the level 1, which means after you get the inputs, but you need to adjust some discounted rate or whatever rate to measure your assets. So that is level 2. Level 3 are the inputs is unobservables. Okay, let me give you an examples that in the okay, for level 1, a small investment in quoted shares. So you use the quoted price, as I mentioned just now, you use the quoted price. Okay, it's observable in the market. That is level 1. For level 2, an investment properties. Okay, you use the price per square meter from observed transactions in a similar properties. Okay, for example, you use bricks or whatever to see, okay, that area, okay, my market price is how much per square foot. Okay, but eventually you need to adjust the pricing, because it even if similar, but maybe the size or the locations or you are in the middle, that is the not detached house or whatever, then you have to adjust certain things to that pricing. So that is level 2, which means you can observe and unobserved you put together. Okay, that is level 2. Level 3 is you use the previous price adjusted for estimates of the factors that will affect this year's price. Okay, all the inputs are unobservables. You cannot get it directly from the markets. So that is level 3. Why I need to show you what is level 1, 2, or 3 that you measure your asset is because of the disclosure requirements. Okay, eventually when you use level 1, 2, 3, you have to disclose in your financial statements if you are using fair value measurements. So you have to disclose what is the carrying amounts at the end of the period, what is the level of the fair value hierarchy, and descriptions of your valuations techniques for level 2 and 3, because level 1, you don't have to show your techniques because you can get it directly. But level 2 and 3, you may adjust something like discount rate or whatever. So you have to show your descriptions. Okay. And at level 3, you also have to disclose the total gain or loss for the period recognized in the profit or loss or other comprehensive income. So these are the new requirements to be disclosed in your financial statements if you use fair value model like investment properties. What I see in our current financial statement, mostly some are the mostly those at fair value are those investment properties value at fair value model. So eventually you will need to disclose all this. Okay, if you measure at fair value. All right. Now is 10:27. Maybe we come back at 10:45. All right, then you think if you have any questions, then you post to the chat box or Q&A. All right, so I stop now. Have a great tea break. Thank you. We come back at 10:45. Okay, everyone. Now it's 10:45. Sorry. Let me share my screen. Okay. I'm sharing my screen, yeah, on the slides number 49, sections 19 for business combinations and goodwill. Yeah, eventually I've just left about 40 slides only. So I hope I can go through that until the morning sections, then we can off earlier. Okay. Everyone's back, yeah? Okay. So what are the amendments in relations to sections 19 on the business combinations and goodwill? Okay. The definitions revisions, the business combinations now are focused on the control acquisitions. Okay, actually it has been interrelated with the sections 9 as we discussed this morning. Okay, so there's been new rules on the acquirer identifications. Okay, new rules clarify on how the entity identify the acquirer, especially in new entities. Okay, new entities being incorporated, not necessary to be the acquirer of the companies lah. Okay, so later on we will be going through that. Okay, and the fair value measurements, there's these new contingent considerations that you need to measure at fair value. Again, not just the considerations that you receive is your fair value, but you also need to consider the contingent considerations to be measured at fair value as well. And another changes will be on the step acquisitions remeasurements. All right, later on we will be going through one by one. Okay, what is the definitions of the revisions? Okay, currently, the definitions for business combinations is a business combinations is bringing together of a separate entities or business into one reporting entity. Okay, see, yeah, bringing together separate entities means A and B, okay, into one reporting entity, consolidated to become the consolidations. Okay, now they revise to a transactions, okay, a transactions or other event in which an entity, means the acquirer, obtains control of one or more businesses. Okay, obtains control of one or more businesses, the acquiree. You have to consider, okay, if there is a business, then it's a business combinations. If it's not a business, then you cannot recognize that as a business combinations. What's that mean? It's very complicated. Again, let us see what is the definitions of a business first. Okay, so this is the definitions for a business. Okay, we read together. A business is an integrated set of activities, okay, and assets. Activities and assets are not just assets. Activities, a set of activities and assets that is capable of being conducted and managed for the purpose of providing goods or services to customers. All right, generating investment income such as dividend or interest, or generating other income from ordinary activities. Okay, what do you consider a business? Okay, a business, you must have these three elements. Okay, let's read, continue. A business consists of inputs and processes applied to those inputs that have the ability to contribute to the creations of outputs. In order to be defined as a business, you must have these three elements of a business, which is the input, the process, and the output. Okay, you must have these three elements, then only you consider this as business combination. So in the standard, all right, there's a definition of the standards, right? There's an optional concentration test. Okay, you see, it's substantially all the fair value of the gross assets acquired in concentrated in a single asset of a group of assets. Yes, then this is not a business. Okay, if you cannot apply the concentration test, then you have to assess whether any acquired process is substantive. Does this set of assets includes an input and a substantive process that significantly contribute to the ability to create outputs? If yes, then it's a business. If no, then not a business. So what's this? You understand what is this? Never mind. I have a quiz to tell you what I mean, the concentration test, and what is the substantive test, okay, that you define that is as a business or that is not a business or just merely acquires of assets. Okay, let's see. This one, entity X acquired a commercial building, from entity Y. So this commercial building is an investment properties from entity Y. Okay, the building is fully tenant, means it's fully tenant. Everybody is every units are rented out. Okay, and is managed by an on-site property management team. Okay, there's a management team that's organized. Okay, to organize the rental payment or whatever lah, employed directly entity Y. Okay, let's say entity X to require these investment properties. Okay, so the acquired of investment, this is you see this scenario, the acquired investment properties include a set of activities. Let's say the building and land is 50%. Okay, percentage fair value in relation to this. Then the existing lease agreement with tenants is 30%. All right, you see, the land and the building and the land, the portion of it is 50%, the lease agreement 30%, and the operating procedures or manuals is 20%, like transfer of key property management staff, supply service, contracts, IT. Okay, so is this an acquisitions of investment properties or acquisitions of business? What do you think? Okay, so you see, because when I acquired this investment building, I acquired a set of activities, not only the building itself, the land itself, but also I acquired the lease agreement with the tenants and also the property management staff, 50, 30, 20. Okay, I've acquired a set of how to say, the commercial building and also a set of activities. Just now what we mentioned here, right? A business, if there's these three elements, the input, the process, and the outputs, right? So then you consider that's a business combinations. So if you acquired this building land, the lease agreement, and also the transfer of key management staff, so is this an acquisitions of property or acquisitions of business? Actually, I'm using a slideshow, but now I cannot use the slideshow. So you can see the conclusion. Yes, it is a business combinations. Okay, why? So you see the analysis. You see, is there an acquisitions of business. Okay, so you need to apply judgment under sections 19 to assess whether it constitutes a business. So does it meet the definitions of business? Okay, as I said, you must include inputs, you must have inputs, okay, your processes, and you have this input and processes to generate your rental income. You have your land, your building, these are your inputs, right? Then your processes, you have a team of management staff to collect rental, to operate the buildings, to generate the rental incomes to you. So you are not just purchasing the properties, but also a set of business. Okay, just here, the analysis input acquire, okay, your lease, your tenant, your staff, your property. Your process, you have your system, your workforce to manage the properties. And you get your rental income from the tenants. So this is your business combinations. If business combinations, then only is a business. Then you consolidate this business. All right. Okay, let's see if the scenario change when you acquired this commercial building. Okay, the building is fully tenant and managed. They have the same same scenario as per above. You also acquire building, but the fair value percentage when you acquired this, the more you pay is for the building and land, which is 90% of the fair value is to the building and land, while the remaining is only 4 or 6%. So do you consider this is the acquisitions of a business or acquisitions just merely an investment properties? Very obvious is the acquisitions of investment properties, because most of the fair value of the considerations is allocated to the building and land. So this is the acquisitions of investment properties. Okay, so is the primary asset identified? Yes, it's a commercial building. Okay, fair value concentrations, okay, 90% is commercial building. So substantially meets or exceeds the accepted substantially or threshold. Substantially is belong to the building itself. Okay, the remaining is insignificant. Okay, 10%, blah, blah, blah. So it's clearly the core value is for the asset, the buildings that you acquired. So do the other asset form a separate business? Oh, no, they do not form a substantive set of inputs and processes that are capable of producing outputs without the properties. Okay, so as a conclusion, if this is the case, this is not a business, right? And should accounted as section 16. Section 16 is what? PPE or IP. Okay, so the fair value is in the single identifiable IP. So it's just purely an acquisition of assets under section 16, right? Not section 19 as a business combinations. So you have to satisfy the test, concentration test. All right. Okay, after you identify, okay, oh, this is a business. So I need to this 5-step approach. Okay, so after you identify this is a business, so you have to identify who is the acquirer. If this is business, then you have to do the business combinations, right? So later on, there will be 5 steps for you to determine Step 1, who is the acquirer? You have to determine or identify the acquirer. Okay, then step 2, determine the acquisition date. What is your acquisition date? When you acquired the business. Step 3, then you have to recognize and measure the identifiable assets acquired. Okay, what are your identifiable assets? What is your liabilities? And if there is any non-controlling interest in the acquiring, perhaps you are not acquired the whole percentage of the investees, so you have to identify that. Then step 4, you measure the consideration transferred. Okay, what is your considerations transferred? Your proceeds, huh? Then step 5, you recognize and measure if there is any goodwill or negative goodwill. All right. So after identify the business, okay, it's a business combinations, then you have to determine these 5 steps. Okay, who are the acquirer, the acquisition state, blah, 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 and you recognize your goodwill. Right? Okay, so there's this new added requirement explaining that an entity newly formed to effect a business combinations may not be the acquirer in the combinations. Again, in our mindset, when there's a entity form, like what perhaps form, okay, a new company that is formed, ultimately that company is the acquirer. But now there's an added new requirements explaining that it could be otherwise. That company may not be the acquirer in the combinations. Okay, so see, a new entity form. This is in para 19A, capital letter A15. All right. A new entity formed to effect a business combination is not necessarily the acquirer. If a new entity is formed to issue equity instrument to effect a business combination, one of the combining entities that exist before the business combination is the acquirer in accordance with para 19.10 and the guidance in this paragraph. In contrast, a new entity that transfers cash or other asset incurred liabilities as considerations might be the acquirer. So you see who is the one who has the asset and incurs liabilities. That is the acquirer. Okay, you may refer to this para 19A point 15. Okay, it's just added that a newly incorporated entity may not be the acquirer. So you have to determine who is the actual acquirer that issue cash, okay, to acquire these entities. So there's this new updated references to the definitions of assets and liability to those revised in sections 2 and updated the recognitions of requirements for contingent liabilities. So I think previously we don't recognize all this or we don't bother about these contingent liabilities at all in our business combinations. But now from 1st January 2027, you have to consider this, not only the fair value of the considerations that you pay, but also you have to determine what is the contingent liabilities. The fair value of the contingent liabilities. So currently there's none. You don't have to contingent considerations. Sorry, just now I mentioned about contingent considerations. Okay, before that, you don't have to consider others. But now you have to recognize the fair value of the contingent considerations. Okay, the revision is the acquirer shall recognize the acquisition date fair value of the contingent considerations as part of the consideration transferred in exchange for the acquiry, if the fair value of the contingent consideration can be reliably measured without undue cost or effort. That's stated in paragraph 19.26. Okay, I got one example. What does this mean by the contingent considerations? Okay, let's say now you company A acquires company B, all right? So, okay, company A acquires B. So company B owns a factory site where there's a risk of environmental cleanup costs due to past contaminations. The obligations is possible, and based on expert assessment, the fair value of the cleanup cost is estimated at 200,000. Okay, so this cost can be measured reliably without undue cost or effort. So at the acquisition stage, this company A must recognize the contingent liability at fair value as part of the purchase price allocations. Okay, you have to recognize this 200,000. Okay, together with your fair value of the your proceed, your payments. Okay, you have to include this contingent considerations as well as part of your considerations. Okay. Okay. Another changes would be these step acquisitions. Not changes, now it's amendment now. Oh, because currently there's none of the standard mentioning on step acquisition. What is step acquisitions? Which means you have already owned some shares, but later on you buy some more shares to gain controls. Okay, step acquisitions like a staircase. You acquire a bit by a bit until the end. All right. So there's this revisions. Okay, an acquirer sometimes obtain controls of an acquirer in which it held an equity interest immediately before the acquisition date. The acquirer shall remeasure its previously held equity interest in the acquiry at its acquisition's fair value and recognize the resulting gain or loss, if any, to the profit or loss. Okay, what this means, as I mentioned just now, it's like a staircase. You acquired the company step by steps. All right. So it's mentioned how to measure the equity interest if this is the case. Okay, you can read on your own, your leisure time. Okay, and I have this example. Maybe we go through this example if business combination achieve in stages like staircase, for you to understand what is mean by these step acquisitions, this para. Okay, on 30 June 2001, SMEA held 400 ordinary shares in SME B, 400. Okay, which is only 10% of SME B ordinary share. Okay, I hold 400 share, and this 400 share only represent 10% of SME B. Okay, at that moment, it's just purely financial instruments, right? And just measure that and cost less impairment because just 10%, right? So it's just purely your financial instrument, your investment in accordance with paragraph sections 11, financial instruments. Okay, so let's say the carrying amount of the investee was 3,000. Okay, as at this 30 June 2001. Okay, on 1st July, this SMEA is going to acquire the remaining 90%, okay, which means 100% already. 10% is before 1st July 2001. I hold 10%. My carrying value is 3,000 in my balance sheet, 3,000, okay, as a financial instrument, all right? And then after 1st July 2001, I acquire the remaining 90%. Okay, then I have this valuable report. The acquisition state fair value of SME B ordinary shares is 10 ringgit per share. Okay, let's see. When I remeasure, okay, I got my acquisition date fair value 10 ringgit per share, right? So initially I've hold 400 shares, right? Because now you have to remeasure your previously held equity interest at the acquisition date fair value. You have to fair value the previously held equity interest. So the fair value of the shares is 10 ringgit, right? So 10 ringgit times 400, your previously held equity interest is 4,000, correct? 4,000, huh? Okay. Then you have to recognize the gain. Because you say it's 4,000, my carrying value in the balance sheet is how much? 3,000, correct? 3,000. Remember, financial instrument, 10%. My carrying amount is 3,000. But now, my shares now worth 10 ringgit per share, which is 4,000. So there's 1,000 differences, right? So you have to recognize this 1,000 to your profit or loss. This is a gain. Initially, that's 3,000, but now fair value 4,000, then you have to recognize the gain to your profit or loss. Okay? So this is what they mean. You have to value your previously equity shares at the fair value amount. Whatever differences you just recognize to profit or loss. Okay? Then only you include that 4,000, the 10% is 4,000, right? To calculate your goodwill. Okay? So this is what it means with this new standard. You have to recognize the gain or loss if you encounter these steps acquisitions. Okay? Okay, so now we will be going through sections 23, which is the revenue from contracts with customer that you are familiar of with the 5 steps model. The 5-step model. Okay, and this has been aligned with the IFRS or MFRS 15. Okay, they are focusing on performance obligations and the contract analysis. All right. So what is the 5-step model? I believe quite small weight. Sorry. Okay. I think all of you familiar with this 5-step model? Not sure. Okay. First thing, you have to identify if there's any contracts with your customers. Then after identify the contracts, okay, there's a contract with your customers, that's a relationship. Then you have to identify what are the promises in the contract. Okay, the difference here is promises and not performance, right? In MFRS 15, they are mentioned is performance, but here is promises. What is the promises that you give to your customer in the contracts? Then, thirdly, after you identify what are your promises, then you have to determine what are the transaction prices to each of the promises. Then after you determine your transaction price, you have to allocate the transaction price to the premises in the contract. Then you have to recognize the revenue when the SME fulfills the promises. Sounds complicated or sounds familiar? I'm not sure what will going to happen in 31st January 2027, when you have to identify all this revenue. You have to determine whether there's any contracts or what are the promises, whether it's distinct or not distinct. You have to read all this stuff. And that's leisure time you have to read. Okay. But I just show you an example. What do I mean by this 5 steps model? Okay, let's say you see there's this sales of electrical goods. A trading company sells electrical appliances to a retailer. Okay, so this contracts includes 500,000 worth of goods, free installation services, plus 1 year warranty. Okay, if now 500,000 then 500,000 I recognize at my revenue lah, 500,000. I sell, you buy, then 500 lah, that's my revenue. But now you have to step by steps. If that's 500,000 worth of goods, it includes installations lah, warranty lah, then you have to be cautious, right? Okay, let's see step-by-step applications. So you identify the contract with the customer, whether there's a contract exists or didn't exist. Okay, it exists because there's a purchase order with agreed terms and conditions. Okay, so you identify, okay, there's a contract. Okay, then you identify the promises in the contract. First thing, you deliver the goods. That's the goods. Second, you promise for the installation services. Third, warranty. Okay, maybe a separate allocation if provide additional service. Okay, you give 1 year warranty. Okay, so you identify these 3 promises in the contracts. Okay, just now step 1 and step 2. Then step 3, you determine the transaction price. Let's say 500,000 is total, right? But because you include installations, okay, and the warranty, maybe if you have also installation. If you don't buy goods from me, I can help you to install, then maybe I charge 20,000. Okay, if I give you a warranty, then maybe I charge 10,000. That is based on standalone selling prices. If you cannot distinct the contract, okay? Let's say 500 then estimated 20 and 10. So you have to allocate the transaction price to the promises, which means your installation now costs 20,000, your warranty 10,000, your goods is only 470 to the goods. Okay, so you have to allocate these transaction prices to the promises. Then step 5, only you recognize revenue. Okay, when you recognize the revenue, goods is at the point of delivery, right? If you delivered the goods to your customer, then you recognize your goods at 470,000. But you don't recognize your 20 and 10 first because your service haven't completed yet. So you can only recognize when the service is completed, and warranty you recognize over the warranty period. Okay, this is what the concept from the revenue from contracts with customers, the 5 steps model. Eventually, in the current campus, it's very easy. You don't have to allocate those transaction costs or what determine the promises in the contracts. Okay, for informations, those constructions contracts, the property development activities also have to apply sections 23 because it's also revenue from contracts with customers. All right. Okay, so we have going through all the major amendments to the standards. That's the principles and the amendments. that you need to be cautious when it comes into effective. So you need to understand the measurement, I mean the changes behind all this lah. Okay, so here comes the minor amendments. The statement of cash flows. Okay, there's these two new paragraphs in relating to you have to disclose the changes in liabilities arising from financing activities. That is para 7.198. And also they have this new para on supplier finance arrangement, para 719B and C. Okay, you can go and read. Okay, what is this changes in liability arising from financing activities? Okay, so from 1st January onwards, 2027 onwards, you have to the entity lah, not you lah. Okay, even though I know we have to prepare for our client. So you have to disclose a reconciliations between the opening and closing balances in the statement of financial positions for liability arising from financing activities. This is to align with MFRS 7 statement of cash flow, right? MFRS 7 has already present this, and now it's also applicable to this MPERS under section 17. Okay, you have the reconciliations, you shall include all this the changes from the financing, blah, blah, blah. Okay. Never mind, I will show you an examples, okay, for illustrations purposes. So let's say this is the financing activities. Okay, you issue your bond, your repayment, payment of lease liability. Okay, this is cash flow from financing activities. This is the financing activities that are included in your cash flow statements. Okay, this is the liabilities in your balance sheets. Okay, where you have bank borrowing, lease liabilities. Okay, so you have to show your reconciliations for these financing activities. Okay, you have to show your opening, then you recon all the way to your closing balance. Let's say I take an example, the bank borrowings. Okay, you see the bank borrowings 400, right? The opening is 400, correct? Then you show your cash flow. In your cash flow statement, there's repayment of bank borrowing 100, right? So you show your cash flow, I pay 100. Then how to go to your 200 closing? It's because of the Forex. This is the non-cash flow items. Okay, it's because of the Forex. Okay, we see another example is the lease liabilities. Let's say the lease liability 200, right? The closing is 300. Okay, how you have to do your reconciliations up to the closing. So what is your cash flow in your financing activities? It's 50, right? Payment of lease liability. So you minus out the 50. What is the changes? So it's financing cash flow. Maybe additions, your additions of the lease liabilities. Maybe you buy a new hire purchase. Okay, so that's financing cash flow. Okay, so this you have to also include it in your financial statement to show the reconciliations for all the financing activities. All right. Okay, now comes to another amendment. I think this is the additions to the statement of cash flow where you need to show that in your financial statement if you have this supplier finance arrangement. So what is this finance arrangement? Supplier finance arrangement. Okay, this is the exhibits or illustrations to explain what supplier financing arrangement. Let's say you buy goods, SME receive goods or services, okay, the buyer, and there's a supplier. Okay, between the supplier and the buyer and supplier, that's the financial institutions. Where SME agrees to pay the financial institution at a later date when they buy goods from the supplier. The financial institution pays the supplier. Okay, again, when SME buys the goods, okay, and it arranges a financial institution to pay to the supplier first, and SME, I agree to pay the financial institution at a later date. Okay, so this called supplier finance arrangement. Okay, in paragraph 19B in the section 7, okay, what's not a supplier finance arrangement? If this is the arrangement that's solely for credit enhancement only, which means financial guarantee including letters of credit used as guarantees only, this is not a finance arrangement. And if instrument used by an entity to settle directly with a supplier the amount owed is not a supplier finance arrangement, like you use a credit card to settle the amount owed to supplier, it's like you use a credit card, you swipe your credit card first, then you pay the supplier, then later on you settle the bank. Okay, this is not the supplier finance arrangement. All right. So that is stated in section 7. So if there is any supplier finance arrangement within that entity, you have to disclose this in your financial statements. Okay, what is the key terms, the conditions, the carrying amount, non-cash changes, and the range? Okay, as usual, I show you the illustration on the cash flow. Okay, the the supplier financing arrangement with finance provider actually is almost the same as like what I've shown you like just now lah. Hey, you just need to show your reconciliations if it's settled by a service a finance provider. Okay, maybe you can have a look later on when you get the slides. So this is just an illustrations if there is lah. Okay. Okay, section 4 on the statement of financial positions is also just a minor lah. It's just a removal of requirement to disaggregate trade and other receivable arising from accrued income not yet billed as consequence of the rise. Okay, they have removed this wording lah, the accrued income not yet billed, because of the revise of sections 23, the revenue with customers. Just a minor changes. And section 6 on the statement of changes equity, there's a new added new heading on the information to be disclosed, that is para 6.6. So from now from 1st January, you have to disclose in your notes what is the amount of dividends proposed or declared before the financial statement were authorized for issue. So now you have to disclose this already. Okay, but not recognized as a distributions to owner during the reporting period, and the amount per share. Okay, you have to show the amount per share already, and the amount of any cumulative preference dividends not recognized. Okay, there's this new disclosure note that you have to be aware of. Sections 8, notes to financial statement. Okay, now they require disclosure of material accounting policy information instead of significant accounting policies. Okay, which means you only have to disclose those really affected the accounting policies that affected your specifically to the entity itself. You don't have to copy the whole stack of your standards in the MFRS into your accounting, to your financial statements, just on those material accounting policies. All right. For instance, like PPE, normally we disclose initially we recognize at cost then subsequently we can recognize at revaluations or at cost or blah blah blah. But now, if there's no revaluations, then you don't have to put your revaluations. Subsequently, I also measure at cost, then you just mention the cost. You don't have to like copy the whole stack of your MPERS to your financial statements. You have to determine what is your material accounting policy information specifically to the entities only in your financial statements. All right. Okay, sections 34. That is on specialized activities. Okay, there's this new paragraph, 34.2a on the barrel plants. Okay, this section does not apply to barrel plants that at initial recognitions can be measured both initially and on ongoing basis separately from the produce on them without undue cost or effort. Okay. However, this section applies only to the produce on the barrel plants. If at initial recognitions an entity determines that barrel plants cannot be measured separately, I think most of you like this sentence. Without undue cost or effort, this section applies to the entire plant. That means there's no, I think, not much changes from what we show now lah. All right, there's no changes, but there's this added para in the MPERS sections. If you can identify that, then you have to separate the barrel plants and also the biological assets. If you are using the undue cost or effort, then you can apply to the entire, the barrel plants and the biological assets together using the undue cost or efforts. Okay. Okay, so sections 34.17 to 34.6 in the old MPERS relating to property development costs have been deleted in new sections. So these property development costs, you have to use sections 23 on the 5 steps model, as I mentioned just now. Right? I think I'm going to have my last sections on the transitions requirements and reliefs. Some might have reliefs, exemptions, where you don't have to go back to the first contract. Okay, sections 9, 11, 12, 19, 23. I think you can read it on your own. What is the transition requirement where you can apply retrospectively or prospectively. All right. So that's the end of my slides. Is there any questions? Okay, why I have to give this training at this moment? Because maybe you have to tell your clients about that. Due to this, there's this new MPERS 2025 effective from 1st January 2027. So you can explain to your client, okay, whether you need to adopt earlier applications, or you need to adopt 1st January, or you need to get ready all your informations. Correct? Because some of these, you might need to get informations from your clients for the like impairment, the cash flow, all this, you have to get ready lah. All right? And also you can use this, maybe your client, do I applicable to the audit exemptions? Then maybe you can use this as an excuse. There's this new MPERS 2025. Do you have the manpower or or any professionals to draft all these accounts. So I think that's a great opportunity for us to retain the client. All right. Is there any questions? If there is none, I will ask Amy, okay, my admin assistant, okay, will email the slides to you. Maybe you can read further, or you can go to, okay, let me show you where you, for those newcomers lah, where you can, wait, okay, where you can go to search your MPERS. Okay, so this is the MPERS website. Okay, you can choose this accounting standard for private entities, or if you want to find your MFRS, you can go to this other than private entities. So you click here, private entities. Okay, there's this new MPERS 2025 and old MPERS 2016. Okay, let's see, you click on it. Then you click. Okay, you have to read all the disclaimer and copyright. Then you say you have read and understood. Then only it will appear as a PDF. Okay, to the MPERS, where you can read all the standards as I mentioned. Here there's a table. Okay, what is the subject of amendment? Okay, so you can read what are the amendments, the summary lah, huh? What are the amendments that I show you just now? What is editorial amendments? Okay, what is the additions requirements? Okay, this is like a summary lah, to what are the amendments to the respective sections. Okay. Okay. If there's no questions, then we shall end here. Remember to join the training tomorrow on deferred taxations that will be presented by Mr. Dusun Chong. Okay, for those who don't know or not sure how to do deferred tax, that's a great opportunity for you to understand what is deferred tax, what is deferred taxations, and how to calculate deferred tax. I understand that Dusun has an example to show you how to do the tax, how to do the deferred tax. So make sure you join the training tomorrow. Okay, thank you, everyone.